Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing our X Dividends Next Week segment, where we use Dividend.com to locate 40 some stocks that have X dividends next week. We take those stock tickers, enter them into Y charts, and do a very quick screening process looking for stocks that have a PE under 25, yields over 2, increasing revenue, increasing net income, increasing free cash flow, because those are all very important aspects to our fundamentals to any dividend stock. And then that gives us a very, from 40, 50 stocks, that screens us down to usually about 4 to 6 stocks that we can do a deeper dive on and kind of see what are some undervalued ones that could potentially be good buys. So let's go ahead and get started over on Dividend.com. If you guys haven't checked out this website, I have a whole video on how you guys can search for a dividend, see how much a stock is paying out dividends every quarter or when they're going to be paying out dividends such. That's going to be in the top right corner. If you guys want to click on that video, and it has a really good example of how dividends are removed from a stock on the X dividend date. So here we're going to be clicking on X dividend dates. And I'm going to go ahead and uncheck everything besides the common shares. Now we're looking for dividend stocks between the 19th of March and the 23rd of March. And then all we're going to do here is select search, and that's going to give us a whole bunch of stocks here. Now I'm only looking for the highest rated stocks. So I'm going to be going ahead and adjusting it by the DARS rating. So this is actually pretty uncommon here. We have some 5.0 stocks. Normally, I believe in our past videos, we haven't seen any stocks with, I believe, a rating higher than 3.9. So in this example, we have 3 stocks that have a rating of 5. Now, stocks are rated between a rating of 5 and 1. 5 being the best, that means that they have very good dividend growth, they have a very good dividend yield, they're expected to have in the next 4 quarters be positive. They have increasing, years of increasing their dividend and increasing it by a very nice percentage. And then as it goes lower and lower, then some of those aspects are missing. So what we're going to be adding from these stocks here, we're going to be adding everything with a 3.4 and above. 3.4 is neutral. So it's not really bad, but it's not really positive. It's sort of neutral. So you can see here that there's many stocks in here between the 5.0 and the 3.4. So a few of these that people may have heard of are Las Vegas Sands, Main Street Capital. We have International Game Technology. So there's a few names in there. Dr. Pepper and Snapple. So that's Best Buy. So a couple of them in there that I recognize. So all we're going to do here is now take Y charts here. Now Y charts, I have a whole nother video on that one as well. If you guys are interested in checking out how you guys can access Y charts for free, go ahead and link in the top right corner another video if you guys want to check out Y charts and how to access that for free. But all we're going to do here is take these ticker symbols and just type them in here on the left hand side. So if you do watch the other video, it shows you how to get access to it for free, and then it has all my financial metrics that I use in the screening process that come with the link. And all we're going to do here is just kind of go down. So I'm going to go ahead and pause the video, otherwise it makes the videos very long, and then I'm going to continue entering all these stocks in from car all the way down, and then I'll be right. Okay, and we are back. So what I did here is I included all stocks with a 5.0 rating, and I actually took it all the way to 3.2 because there's only one 3.2, and then it drops off into the 3.0s. We can actually include the 3.0. So I'm going to go ahead and enter Tupperware and Big Lots. We have Big Lots here in my city. So that's it. We have all of these stocks entered in now, and they have the X dividend date here and the pay date, but we're not worried about this right now. All we want to do is screen these stocks here on the left hand side so that we can get our list down to a very positive number. So what I'm going to go ahead here is our screener only screens about 10 stocks at a time, so I'm going to go ahead and uncheck some of these. And then the very first thing I'm going to be screening them for is a PE ratio that is greater than 25. So right off the back, we have Medtronic, MDT, which is removed, International Flavors, that's going to go ahead and go away. Then we have Camin, never heard of that one, but that's why I do this whole screening process. So there's many stocks in here. I have never heard of their name, so Sabre, never heard of their company, but they do have a PE greater than 25, so I went ahead and removed them. So here we have a few companies here remaining that have a PE ratio less than 25. So I'm going to go ahead and check the next one, uncheck the prior ones to kind of keep my spot. They kind of go down the list here and then select some more to kind of continue the screening process. So US Physical Therapy is removed now, and we have Techie one here. So a lot of times you won't ever read into many stocks outside of what's on the news or what your friends are telling you. So I like to do this whole sort of screening process going over to Dividend, Dividend.com and checking out ex-dividend dates, just because this gives me exposure to a variety of stocks I would never have even heard of or even thought about researching on my own. So this allows me to kind of look at a few other stocks and screen them very quickly. So instead of having a list of around 40 stocks, I'm going to end up with a list of around 6 stocks, and I'll be able to choose some of the ones there that are remaining that have increasing dividends, that have a long history of increasing their dividends. They have good growth, so every time they increase their dividend, they increase it by, say, 5 to 10% or even larger. So that's what we're going to go ahead and screen these for. And then, of course, they're going to have very nice yields. So Hyatt is our last one there that's removed. So there we are. So now we're only have a few stocks left. Maybe there's 20 some stocks here that are remaining. So we have very quickly, so Philip Morris, that's one that I know of. I think I own that one right now. I'm not sure. Let's see here. So everything else here has a PE of 25 and under. So nothing escaped our screening process there. The next thing we're going to be doing is looking for yields that are over 2. So I want to go ahead and remove any of these yields here that have a yield of 2.0 and below, because if you have $100 invested and you're getting only anything less than $2 doesn't seem too high, and if it's going to be increasing dividends year over year, you want that very nice return. So if they have a yield of 41.41 for every $100, you're only making 41 cents, versus if you have a yield of 5.95, you're making $5.98. So the lower the yield, it may not be as risky of a stock. The higher the yield, it may be a little bit riskier. So that's something to consider, but we're going to be taking a look at this time. Many of these retail stocks, Big Lots there, for example, is a retail stock. It could have been through that correction recently. It took place in February and got to a good point where it could be bought at a discount. So let's go ahead, and I'm just kind of jibber-jabbering now when I should be unclicking items. So I'm going to go ahead and continue through this, and all I'm going to be doing is removing stocks here that have a yield under 2. Now you guys do not have to. If you guys want to remove stocks that have a yield greater than 1, for example, or you want to remove stocks that have a yield of greater than 5, just because you don't believe that these companies here that have yields over 5 are good companies, then you guys can go ahead and do that. But I think in this current time frame, there's stocks out there like AT&T and Verizon. They're great companies. They have dividend yields that are around 4 to 5. So there are stocks out there that Pandora, I'm not sure how that one got on our list here, but it is right there. So I may have accidentally entered that one in there when I didn't mean to, or I did include another one when I should have. So I'm actually almost done here, so I'm going to go ahead and just keep you guys there without pausing, and we'll just kind of continue through here. And we are down. So Best Buy there, their yield did kind of come down. It used to be in the 2s, but recently they jumped up quite a bit due to their last earnings. I don't know, I believe they did beat their earnings, and their online presence was actually increasing, so they were able to kind of compete with Amazon, and people thought that was very nice, so their stock did jump quite a bit. So there we are. Now we have about 10 or so stocks now that have PEs under 25, dividend yields over 2. Next, we're going to go ahead and look for increasing revenue, free cash flow, and net income positive over the last 10 years. So Cars, the very first one, has increased their net income by 1.46 thousand over the last 10 years. Their free cash flow is up 241%, and their revenue is up 97%. So that one's going to stay on our list. Cincinnati Financial, again, very positive. Douglas Dynamics, very good, very positive. IGT, so here, their net income has dropped very quickly here. You know, their revenue has been pretty slow, 64% increasing. Their free cash flow is down by 103%, and their net income is down over 1.19 thousand%. So here, if we actually remove the percentages, we can see here that they dropped. They're actually down in the billions now. Possibly, you know, I don't know what their cause is, but looks like it just happened during the last few quarters. So this would be something you would read over the last two 10Ks and the last couple quarterly reports here to kind of see what the heck happened here. But that one's going to go ahead and be removed from our list, and we'll kind of continue down to Main Street Capital. So Main Street Capital, very positive. Everything is in the thousands. Las Vegas Sands, everything is positive. So we're going to end up with quite a bit of stocks here that are all positive. Generally, if you guys have ever watched through some of these other videos, we remove quite a bit of stocks here. We'll end up with around 15 stocks, and then we'll be thinning it down because free cash flow will be down either by a certain amount. Now, this sort of free cash flow isn't too bad. You can see it's coming back up, and these could have been acquisitions, but we have so many already positive stocks. I'm going to go ahead and just remove it here. So net income and Tupperware is going down. The free cash flow is, it's still positive, but it's been on a downwards trend, and the revenue is kind of declining in the last few years. So I'm going to go ahead and remove that one. And then we have Big Lots. So Big Lots again, their free cash flow, this is sort of a buffer for dividend investors. That positive free cash flow means that they have a buffer if they need to. If they ever dip in their revenue, if we go back through a recession, they'll have a lot of that free cash flow available to just dig into and pay out to their shareholders. They won't have to, you know, cut their dividends such as GE or a few other stocks out there. So this one is actually very low here in the net income, only up 25% over the last 10 years. Revenue up only 12%, and their free cash flow is actually down by 12. So here we are left with 2, 4, 6, 7 stocks. So we have Car, Cincinnati. So let's take a look at which one of these actually has a dividend over yield for the last year. So this would give us a very nice indicator over the last year. If their yield is over the price, that means that they recently took a dip, where their yield average is now sitting above for the year where they would normally trade at. So in this example, their price is over the yield. You can see that, you know, about a year ago, back in July, you could have bought the stock at a yield of 3.0, whereas now with their price change, they're at a 2.34% yield. So we have Cincinnati. It's currently trading at a 2.6. So right now the yield is over the price. So this could be one to look at. It could be a good discount price right now. You can see it does kind of go up and down. So this one could be on its downwards teacup position, and you could buy it back on its way up into the. It doesn't look like it actually has too much bounce. Maybe between $75 and $77. It does dip nearly down into the $70 range. This was probably back in February during that 10% correction, so I can see that dipping down 10% nearly and then recovering very quickly. And then we had that second or third week where we had that dip, so the following week we had a bit of a dip. So yeah, you can see the progression there. So Cincinnati, yield over price. Douglas Dynamics, price over yield. Main Street Capital, REITs have been hit pretty hard recently. This is a real estate investment trust, and due to rising increased interest rates, that causes their debt to, when they take out debt in order to buy properties, they get much higher loans because commercial loans are generally 8% or more higher than just generic loans. So, and then that gets very expensive. So Main Street Capital currently has a yield over price. Las Vegas Sands, price over yield, and then Portland General Electric. This is one of the highest yields here that you would buy this stock in nearly, here's 2015. So you're looking at least 3 years since you would be able to buy this stock at such a discount right now, and it could be considered a discount. You could see here that it has dropped, humongous. That again, this is a utility company, Portland General Electric. It's a utility company. They use a lot of debt in order to leverage and buy facilities or buy land or create solar panels and such. So wind farms. So utility companies, they use a lot of debt as well, and with rising interest rates, this causes utilities and REITs to suffer the most. So just in the year here, it is up at a very nice peak yield. This stock could be a great potential buy once it bottoms out. I know that real estate investment trusts have been having some positive movement recently. They kind of go up and down. They're kind of hitting their support level. So this one could definitely be looked into as to, wait for it to kind of finalize its bottoming out point, pick it up, and then ride it back up into the positive area. So this one's much less risky to kind of fall down than to fall down at really high heights. Anyways, so let's go ahead, and now that we have our stocks here, this is something that we've done in the past where we included our dividend, the price, the dividend yield, the price to book value, the PE, and the PE forward. Now kind of just looking at one stock individually here, we can see that this has a price to book of 5. It's been pretty flat. It's pretty normal for that stock. They pay out 35 cents per share over the last 10 years. Looks like they started paying out dividends in around 2013. Cincinnati here has been paying out dividends since back in the 1990s and has been increasing their dividends. Looks like they've had a very nice increasing. Their price to book value is at a 1.4, so it's actually a decent discount there. So instead of kind of going through all of these and price to book there, I like to look at the PE ratios, the price to book ratios, and kind of all the numbers, all the numbers. But let's actually use this information here. Now that we've kind of screened it down, let's go ahead and look up these stocks over on dividend.com now. So, and what I'm going to do is open them in another tab here, and then we can check out how long they've been paying dividends, how often do they pay dividends, what's been their dividend increases over the last few years. So DSW, and then our last one is POR right there. So first one here is Car Auction Service. This is an auto dealership company. The yield is 2.5. They pay out $1.40 per year. They have a payout ratio of 50% roughly, so that's pretty good. Their last dividend increase was right around 12.3, and their annualized growth over the last 3 years for their dividend is 8.6. That's really nice increasing. You can see here over the last, they increased their dividend from 32 cents to 35 cents. So a very nice, healthy dividend increase. Cincinnati Financial, property and casualty insurance. They have a yield of 2.82. They do have a payout ratio a little bit higher of 64.6. They've been paying out dividends and having increasing dividends for more than 55 years. So that is why we were able to see here that they started paying out dividends back in 1990s, and ever since then have just increased their dividend regardless of the recessions in the 2000s and in the 1990s and such. So just continue to increase their dividend. Their last dividend increase was around 4.2. Annualized growth over the last 3 years is around 4.4. And they do have some special dividend payouts. So they pay out normally around 53 cents right now. Looks like they just increased their dividend here from 50 cents to 53 cents. So that's a very nice dividend increase. And then they do have special payouts where they pay out like a random special payout, which looks like one of the okay, it looks like they've done a couple of them in the last few years. So nice looking there. One thing we didn't talk about on these is when are they expected to pay. So CAR, their ex-dividend date is on the 21st of March, which is Wednesday. So you do have to purchase them on Tuesday or prior. Here, March 20th. March 20th is Tuesday, so you do need to buy this one on Monday or prior. And then PLOW, another auto parts company, 5 years of dividend increases, 53% payout ratio. March 21st, meaning that this is a Wednesday one, so you need to buy them on Tuesday or prior, and then you would get paid out there on the same month at the end of March on the 30th. Very low dividend increase, so around 2.1. It averages right around 3.3. So they probably increased their from 24. That actually looks a little bit more than a 4% dividend increase. We could bust out our calculator here, and we can get our current dividend our current dividend payout, which is 265. We subtract it from the old one, which is, I don't know what the heck just happened. So 0.265 minus 0.24, that equals that. We divide it by the current one, I believe, or the prior one. I think it's the prior one. So we'll divide it by the prior one and then times it by 100, and that gives us a dividend increase of roughly 10.4%. So I think that's the correct math, but it is pretty late and I may have butchered that completely. So we have Main Street Capital, 7 years of increase in dividends. Their payout ratio looks high, but the real estate investment trust, this is a REIT, it's a real estate investment trust. It's a diversified investment, and they have to pay out a certain amount of their earnings, otherwise they get taxed at a differently. So here they have very nice increases. They're called the month. I think it's no. I think O is the monthly paying stock. This is another monthly paying stock, and generally they do have 2 special payouts per year. So here we can see special payout in 2016, special payout 2016, special payout in 17 and 17. So I was reading on the Facebook, one of the groups that I'm in, they're talking about they're heavily invested in Maine because they really enjoy those monthly payouts, and then they have 2 special payouts per year that have been doing very nice for them. They're just trying to recover on the income itself, don't care on the stock price whether it goes up or down. If it goes down, they can buy more. They're able to reinvest those dividends, buy more shares, and get paid out more. So that's what they're looking forward to. They don't care about the price going down or up. All they want is the dividends. So interesting one there. LVS, Las Vegas Sands, 5 years of increase in dividends, 90% payout ratio. This is resorts and casinos. One thing to mention is non-qualified, meaning that if it's a non-qualified stock, you do need to pay your full income tax rate on the specific dividends that get paid out to you. So CAR, for example, it's a qualified dividend, meaning that if you hold the dividend for the long term, those dividends will get taxed at a either 0% tax bracket. They'll get taxed at 0%. If you sit at the 12 or 15% tax bracket, you'll get taxed at 15%. If you sit at the 22-25% bracket, and then if you sit at the 39% tax bracket, then you'll get taxed at 20%. So look into the long-term dividend or qualified dividends. If you want research qualified dividends, and then that'll tell you the whole news from the IRS website. I don't believe I have a video on that, but that's something to check out. And then we have DSW, which is apparel store, so a retail company. 70% payout ratio, no dividend increase. So this is probably one I would remove from my list. I wouldn't bother looking into it a little bit further. Looks like they did increase their dividend just recently, but anything prior to that here, you can see that over the last several years, they've just been kind of mellow ever since 2014. They've just either increased it by a penny right there. You can see they went from 19 to 20 cents. So we could actually remove that one from our list. I like to have at least a few years, 5 years or more, of dividend increases. So if we were to rate these ones and put these ones in order of how long they were paying out dividends, we would have Cincinnati Financial at number 1, Portland General Electric, this is electric utilities, 61% payout ratio, 12 years of increasing dividends. Their ex-dividend date is on March 23rd, which is next Friday, so you do need to buy them on Thursday or prior, then you get paid out on April 16th. They have nice dividend increases, nice steady dividend. Looks like they did cut their dividend between end of 1998. They cut their dividend beginning of 1998, and then didn't continue their dividend until 2006. So cut their dividend prior to the 2000 recession, and then during the 2008 recession, they're a utility company. They generally don't cut their dividend because people need their utilities, so they just kind of continue paying through there, and they're a qualified dividend stock. So they recently increased their dividend last February from 32 to 34. So you may see them in the next quarter or so declare a dividend increase on their next earnings. So number 1, Cincinnati Financial with 57 years of dividend growth, payout ratio of around 60%. Number 2, Portland General Electric, at least 10 years, 12 years of dividend growth, 60% payout ratio again. So these two stocks here are pretty much resistant to recessions, we'll say. Portland, they don't have as much history for multiple recessions. Number 3 here would be Main Street Capital, a real estate investment trust with 7 years of dividend increases. The payout ratio is 94%, but they kind of need to because it's a non-qualified dividend, meaning that you will need to pay your regular income tax. And then coming in on the last is LVS, CAR, and PLOW, all with 5 years of dividend increases. But the riskiest one, of course, would be Las Vegas Sands, just because they're paying such a high payout ratio that if their earnings for whatever reason fell, they would actually start cutting into their free cash flow, which, their free cash flow in itself, they're sitting at $3.7 billion of just free cash flow. So I don't think they would get hurt there too bad, but yep. So that is basically it for this video. If you guys have enjoyed it, if you guys have any questions about the whole process, we were able to take a list of roughly 40-50 stocks and really thin it down using Y charts. What we screened it for was a PE ratio less than 25, dividend yield greater than 2, increasing revenue, increasing free cash flow, increasing net income over the last 10 years. And then we took a deeper dive into how long they've been paying dividends, what's their dividend increases look like, when their ex-dividend dates are, and when you would get paid. If you guys would like, here are the ticker symbols. I'll zoom in there. And if you guys would like to do a little bit more research on each one of these, looking back over their 10Ks, I think these are all great long-term, stocks, especially the two that have been paying out dividends for more than 10 years. Just very resistant to recessions, right? Resistant to recessions a little bit. So that is it for this video. Again, if you have enjoyed it, remember to hit the like button below, subscribe for future financial videos. And of course, as a plain disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them and looking for some discount stocks. So thank you guys for tuning in. I will see you next time. Have a great day. Bye.